Facing forward.
Good afternoon, everybody. Welcome back to the Opportunistic Trader. It is just after 1 on December 11th, and now we're joined for another options class by Tom McEntee and Vince Lanci. Each of these guys has tremendous experience, over 30 years trading options, trading a lot of different products. And so I'll let Tom and Vince take it from here.
Hi, guys. Hope you're doing well. Certainly volatile enough. And that's a word we throw out a lot, volatility, right? I mean, I guess, Vince and I are guilty of perhaps overusing the word. At least I am anyway. So what do we mean when we say volatility? And as we look here, this is something that Vince put together, because I am in no way near as organized as he is, I can tell.
This is organized. Actually, so before you get into it, Tom, the purpose of what we're trying to do with this class is we want people at the beginner level to grasp the concept. The purpose of this class is it's two classes in one. The first half will be for beginners, and I wouldn't, beginners not necessarily the word I'm looking for, but people who are learning to grasp at a more basic level the concept of volatility and how to trade it. We're not discussing directional moves today, although they will be implicitly a part of it. And we'll be focused on how to assess volatility without learning Greeks, and that's by using something basically called the butterfly. And it's a P&L graph, and we'll discuss that. And as we move through the class, there'll be a point where we go towards more advanced concepts, but we'll bring it back to the butterfly at the end. The concept, what we want people that are trying to understand volatility to walk away from today is, without knowing Greeks, without knowing volatility, understanding, number one, what volatility means without using the option lexicon, using words like Vega and Kappa and all that stuff. Number two, so we won't put that in human terms. Number two, most of you are probably familiar by now from the previous classes of what a volatility smile looks like. And that smile represents volatility at higher or lower levels. We're going to introduce you to, if you don't already know about it, the distribution, which is the premium of options. So as the smile goes upwards, the distribution is basically a bell curve or some version of that. And then we'll get into more advanced concepts like log normal distributions, model risk, kurtosis, skew, touch on those concepts. And then finally, we'll bring it back to butterflies by throwing an iron butterfly at you. And hopefully, the second thing you walk away from this class with, beginner or advanced, is when Larry talks in the morning about he's looking at the straddle, we're going to read his mind and tell you what he's thinking. At least we think so. So to start off, it's an introduction to volatility, and it's just accounting. Now, I put that title in there because Tom's background is in accounting, and if you just read what's there, volatility is just a standard deviation. So the higher the volatility, the bigger the standard deviation. Right? I can't read the words. Can you see what's there, Tom?
Yeah. You want to go volatile as a standard deviation. Okay. In addition to the mean, we also need a standard deviation to fully describe a normal distribution curve. This is entered in the form of volatility, with some slight modifications, which we're going to discuss as we go on here, guys. So we can define a volatility number associated with a stock or any type of asset class as a one standard deviation price change in percent at the end of a 1 year period. Okay. Now, before we go any further, does anyone? We're assuming, and I know the odd couple joke, that everyone has a fairly good idea of how one would calculate a standard deviation. In other words, deviation from the mean. If the mean is 10, and you have the mean is 10, and you got 14 values somewhat around it between, like a more volatile. A bigger standard deviation would be if I got 5 numbers and 5 numbers of 10. Well, there's no deviation from the mean there. Right?
Just 5, saying 10, with standard 50. Deviation. Right. One standard deviation from the mean is from the middle is what, 82% or 67%?
67. Yeah, one standard deviation is about 67%.
Right. Which we're going to get to as we go down. But volatility is the Greek way, or Vega is the Greek way of saying standard deviation. So volatility would go up 1%. That means the standard deviation, that is one standard deviation, would widen by an equivalent amount. And that's what we're getting at. Twinkle, twinkle, little star is just a comment to myself that, this is the beginning stuff and we need to learn this. So if you scroll down a little bit, volatility, standard deviation, that is all, you get to what Tom is talking about. And that would be, I guess, an ancient pinball machine where people are dropping balls or coins from the top, and you end up with a standard deviation. You end up with a distribution, a bell curve, and you could see based on the percentages what one standard deviation is. It's 68%, and two standard deviations is 95%, and three is 99.7%.
Now, what Vince is saying there, one standard deviation. Let's take a stock, for example. Let's take the Spiders. We'll keep it simple. Spiders are what, $265. I mean, and for time immemorial, this thing has been about a 1% standard. Has been a 1% mover. So, without getting into like why volatility is what it was, you could expect to have a 1% range in that stock every day. So if there's 256 trading days, 16 squared, don't ask me how that works out that way. There's 256 trading days in a year. You would expect that 68.3% of all days should be within one standard deviation. Okay. So right. 68%, roughly 175 of those 256 days, trading days, the market should have a 1% range. Okay. Now, two standard deviations would be a 2% range. And that was, and statistics would tell us that that's a 95.4% probability. So 95% of all the values, or roughly, what's that, about 10 to 13, 14, roughly 244 days should be inside of a 2% move, to be inside a two standard deviation.
If Tom's moving too fast, obviously 365 days in here, a lot of options modelers will set their, I don't do this, but it's very common to set your sheets to 250 or so days a year. When you factor out weekends and holidays, that's about how many trading days there are. So that's the trading year is 250 days, give or take.
That's correct. So, and then here, I mean, this is where, these are three standards. So all values, or I'm sorry, 98, was it 99 point, is that 98.7 or 99.7? I think it's 99. I don't know. I used so 99.7% of all values should be within a three standard deviation move. And that's just cold hard statistic. And you can take any stock and you'll find it. So now, I'm just going to get off a tangent here, but it might be relatable to you guys, is that remember when people were talking about Six Sigma events? I'm dating myself here. When you go back with what John Mulhern was doing at Long-Term Capital, that's about in 1998. Right. All the cognoscenti on TV were talking about a Six Sigma event. But this is a six standard deviation move. So if 99.7% of all value should lie within 3%, should lie within three standard deviations, the odds of that Six Sigma event happening were, this is roughly 3 out of 1,000, right? Three standard deviations. Only 3 out of 1,000 should lie more than three standard deviations away. He's saying it's 6 standard deviations. That's an explanation as to why I lost money. It was so ridiculous that I lost. It's a 6 standard deviation move. It's a Six Sigma move, and the same thing was used to describe.
Yeah,
the same thing you described the mortgage crisis, right?
That's a concept that is indicative, or actually been perverted by, or harnessed the wrong way when people discuss things like VAR, or value at risk. Value at risk is when a firm says our value at risk is $1 million, they're looking at maybe 1 or 2 standard deviations. They're not looking at other aspects of it, such as exit liquidity, because when you have to get out, you can't. Ask anyone who is short natural gas options. They're not looking at 5 standard deviations. They're not looking at log normal distributions. This is a simple bell curve. And as Long-Term Capital found out, Myron Scholes, who I referred to later on, Merriweather, and again, people find out the hard way that betting on one standard deviation moves or selling volatility because of that is a legitimate strategy. But doing it in one product is not. You need to diversify it. There's a term called ergodics, which really is just like saying, if you're going to sell insurance, don't sell it just on earthquakes, sell it on everything. This way you're diversified in your own risk. And that's part of what Tom is saying. One standard deviation may not be enough when you're looking at managing your capital and esoteric risks.
Right. That's absolutely true. And that's critical to understand. So you've got to understand the asset you're trading and what the historical benchmarks are in terms of where the price distribution may lie. Now, obviously, and perhaps I'm getting off on a tangent here, but I mean, I'm just trying to.
No, you can do that. We can. You can.
I mean, anybody who's been here for the better since the site started back in August 1. I mean, I'll give you Tesla for example. Now, Tesla. I mean, would you say it's, without even looking at implied volatilities in the thing, would you say it's more volatile now or less volatile now than it was, say, 2 months ago, 3 months ago, 4 months?
I'm going to answer that question because I actually could be wrong on this. So I'm actually answering like a neophyte. I'm going to say post his comment that the market was too volatile and his statement about 420, it's been more volatile. Although in the last week it may not be more volatile. I don't know.
Well, in the last, you're absolutely, after his comment, that you're 100% right, because after his comment, that sparked a huge. I'm gonna share it over here. I'll share the screen. Vince, you'll love me what I'm doing here. I've really got stuff going on. Here is Tesla. Let me widen this out for you guys. Here's Tesla. This is a chart of Tesla implied vol over the last 12 months. Okay. Now, his tweet came out somewhere. It was like, with the stock traded 387-ish. Was it over here? I'm just trying to think where the stock got to. This is August 1st earnings, and then I think we got as high as up in here, 387, and then we got as low as 244. Okay. His tweet came out somewhere around here. And this, you see volatility. It just took off. Where 30-day stuff was 85 2 months ago. 85. That's when the stock probably traded 244. And yeah, obviously, with the perverse nature of the game, that's exactly right. The apex in vol is usually the bottom of the stock price, because now everybody who's short puts buys them back, and those buyers are gone now. So that's how you usually get a rally off of that. And and a collapse in volatility. Now, obviously, since that came out, stock somewhat stabilized. Now, look at it here. I mean, you've had, and this is from November 6th, so roughly 5 weeks ago. We were as low as 50, got as high as 59, this is as low as 48. So volatility is from 85, whatever the heck it was back in 2 months ago, to about 52 right now. So it's definitely been a much less volatile stock, as the stock has found a home, so to speak, right? I mean, look at this range. This is from October 29. See, I'm playing with this down here. 339, I think. Yeah, 337 to an apex to a top of 3. I think it was trade 3 the other day. To 36 to 370 something. Whatever the heck it got to. Yeah, okay. So $39. I mean, if you got to look at it here, this stock had $39 ranges, had a $34 range in a week. Now it's had a $34 range in 2 months. So it's definitely quieted down. So that's why I think I put in the chat a week or so ago. Maybe it's the time to start looking to buy volatility in there. Now that's counterintuitive to the way most people think, because people want to look at, well, nothing's happening. But history will tell you that things have happened, and when they do happen, it's happened rather dramatically. So on a Vega basis here, now I don't want to get advanced. I'm just going to explain. We touched upon Vega in the last class, and I'll show them a real life example right here. Suppose I'm long volatility in Tesla here at 85. I just think this thing is it's 244. It's going out of business, right? It's all over for Elon Musk. It's 244. I'm going to be buying stock at 101 in a week to cover my short. So I load up with every option on the board. I just buy puts. You guys, many puts I get my hands on. I'm long 85 vol, and nothing happens. Now I'm long Vega. Say I got 1,000 Vega at 85 volatility, all in the front month. Well, how do I do here? Now vol's at 49. We'll say 50. I'm long Vega at 85. I have 1,000 Vega at 85, and now it's down to 50. How did I do? And Vince, why don't you just tell them what Vega is and what happened to me with this decline in volatility?
Well, Vega, which is actually not really a Greek letter, it's a made-up one. It's a bad Chevrolet. If volatility is expressed in percentages, volatility is one standard deviation. Volatility and standard deviations go hand in hand. Vega is the exposure to a change in volatility that you have. So we talked about deltas. If an option has a 50 delta, then every 1% move in a market, or I'm sorry, $1 move in a market would give you a 50-cent move in the underlying option. That is the delta. What Vega is properly, it's the volatility delta. So an at-the-money option would have the largest volatility delta, meaning if the market doesn't move at all, but volatility expands by 1 percentage point, then the option would expand by in value and intrinsic value by X. What is X? X is the volatility delta, also known as Vega. So the Vega of an option could be, let's say, 10 in a low volatility environment. It could be 50. It could be 100. It could be 200. Who knows? It depends on the market. It depends on where the price is. But the point is, given a 1 percentage move in volatility, your total Vega, which is the netting out of all your longs and shorts of options, will change. Higher will make or lose you money by that 1% move in volatility. Does that make sense?
That's, yeah. If anybody responds, just respond. That should make sense. Now I'll show you what Vince was talking about here.
And don't worry if we don't cover everything. This is fine for 2 or 3 classes. We got plenty to talk about here.
Is this Tesla calls and puts?
Thanks, Mike. Mike's on board.
Who's up there?
Mike's on board. I got the others. You've got plenty of screens in front of you. You do that. I'll do the.
You got Tesla. Is this Tesla I'm showing you here?
Oh, you're asking the wrong guy.
No, I'm just showing. Let me see.
Yeah, it's Tesla.
Oh, okay, cool. All right, cool. This is what Vince is talking about. I want to show you something. Here, let's forget about December 14th. That's Friday. That's binary. You turn this on or off, whatever you want to do. Here.
And before you get into this, see on the top left-hand side the smile. Now, the smile also, it's not a perfect smile. It's skewed to one side. The puts are higher than that. That's basically, if you just put the cursor where the at the money is.
This is Tesla, your 367, right in here. Yeah.
Okay, so that's the at the money, and the and that line, what it is doing is it is giving you the volatility level. So as you go further out of the money on the put side, the volatility goes up in the option. By the way, the Vega or volatility delta decreases. So an option that's worth 2 ticks can't have a Vega of 5 ticks. It has to be less than its value. Now, if this were a normal smile, which it is not, it would be just basically a regular smile, equidistant left to right from the at the money. But the reason that this is important is the smile is a representation of volatility in percentages. What we're looking at now, but is directly related to this, is distributions, which are bell curves or log normal or normal distributions, which are representations of the premium, the extrinsic premium reflected by the volatility. So don't think we're changing when we go from smile to distributions. Bell curves are premium or actual monetary value spent on options, whereas smiles are percentages of volatility per strike. Sorry about that digression, but you're with me.
No, that's fine. And guys, I just want to illustrate something because we spoke about Tesla. We'll stay with that. This chart here of this is the volatility smile profile. The more solid line is today. Tesla at the money stuff right here. Okay, 367. I want to go a month ago, and I'll say where the stock was because it doesn't pair it up. A month ago, the stock was 338. So the at the money was roughly 340. And vol was trading roughly around about 52. Today it's trading at about 50. These are today's at the monies are about 49.8. 338 was the at the money in November, was about 52.6. Now 252 was the at the money 2 months ago, October 12, which we referenced before. Here is the at the money option in Tesla on October 12th. 70 volatility. Now, notice how
someone is texting you.
Someone's texting me?
Oh, yeah, that's what that noise is.
Yeah. Hold on a sec. This is beyond my pay grade.
It's a very important text.
What's long and green has an IQ of 4. That's very good.
I'm just breaking Tom's
Vince
ball
went
he's playing.
anti-Aaron on me here. He said, "What's long and green and has an IQ of 14?" And the answer is the St. Patrick's Day Parade. So
there you go. Moving on.
Moving on. Boom. I'll be here all week.
I'm deflecting.
So
back to Tesla.
Back to Tesla. You see what I'm looking? Okay. So now here, this bottom curve here, this is. I'll take out 1 month ago is here, but let's move that out. I want to look at this. You want to look at these. You want to see something dramatic? Here is Tesla volatility today. Okay, this is today's stuff, at the money stuff. 367 vol 50. What do you see? About 52-ish, like that. That's January expiration options. Okay, I want to go back 2 months ago to the bottom of the stock, roughly 252 in the stock. This thinner brown line is option prices that presented for the January trading. I'll look at 30 days. You know what? I'll do that. So I'll compare apples to apples. Let's look at December. This is the January stuff. This is, what am I doing here? October 12th. Okay. Close. No, I'm not getting it. December 21, I should get. Here it is. Okay. This is where we were. No, screw it. I'm not getting that. This thing's not showing me what I wanted to show. Okay, this is where we were. For the stock at 250 roughly. Volatility, at the money volatility in Tesla was somewhere about 68%. Currently available at 50. Currently available at 52. So what I'm saying, this is a very real world example of how you can lose or make a lot of money trading volatility. Okay. Now notice here how this smile or this vol profile that presented in January options back in October is a little less dramatic. You know, maybe for like it's kind of flattens on the upside. Because what you're doing here, these options have really little value because you've gone from 250, obviously skewed dramatically higher for these puts as they are today. Fat tails, and there's fat tails always exist in the puts, but they kind of like flattens out as you go higher. So with Tesla here, you're going to be cognizant, always be cognizant of the volatility you're buying and or selling. That's the most important thing in volatility trading. Like everybody wants to do buy rights when the market's going up. I get it. It's very, very simple. And I'm selling this and I'm going to get 2% if the thing's called away and blah, blah, blah. That's fantastic. Time to be selling it where you can make some real good money when you buy some of these depressed stocks and you're getting paid to sell it. Now you're getting paid to sell it. Tesla right now, for lack of a better word, the tough trade in Tesla 2 months ago was to buy right that stock. Only a complete jackass would have buy written that stock at that point in time at 250 or 260 in the stock, and you'd have gotten paid quite handsomely because the easy trade was to buy options and sell stock. And obviously, that guy lost big time. The hard trade is usually the right trade, and you ain't getting the bottom and you ain't getting the top. So live with it. You put it on and you see where you look out a week or two. Notice that you want to make sure that you have odds in your favor, period. This game is a long run game. It's a marathon, not a sprint. Every other cliche you can think of. And that's it. You do enough things volatility wise. Where am I doing it historical? On a historical basis, is this a good bet? And that's the crux of this whole freaking game. I'm getting a little bit far afield here. When you're trading Vega, be cognizant of where you are, what you're buying. Pardon me?
Weren't we talking about butterflies?
Oh, that's right. Butterflies are free. That was a goldie. I think that was a goldie.
Dude, I'm only giving it to you because I know you can take it. I don't want to lose the beginners because on the whole butterfly concept because although we want to talk about this and we can't talk about it all day, I want to at least give people the ability to walk away today understanding how butterflies work, and as a consequence of that, also understanding how iron butterflies work, and then being able to get more out of what Larry says in the morning when he says the straddle is cheap at 30 and what his thought process is. I just want to get the butterfly part out of the way and then run with that. We could skip around if you like, but you follow what I'm talking about?
You want to do the flies? Let's do the flies. Go ahead. That's a really good. I think what Vince is going to talk about here is a very good concept to really get a.
Why don't I just whip through this, and I'm going to do it quickly. All right, but it's going to be recorded, so you'll be able to see this again. But what I want to do for the beginners or people that want to learn more about volatility in a basic sense is go through butterflies, why you don't need to understand volatility to trade butterflies, but why they are the king or queen of option structures. Okay, so I'm looking at my own screen, Tom. If you could scroll with me, that'd be great. So volatility is standard deviation. That is all. Tom covered that. Okay. All right. That is a normal distribution. Next, overlaying on top of market prices. Admittedly, this is dated, but what you're looking at is, as Tom was talking about, 1 standard, 2 standard, 3 standard deviations. You're looking at the behavior of a market. I think it's soybeans over 1 year and overlaying the standard deviation on it. That's all fine and dandy. We're going to get into what's wrong with models and things like that later on. But we have to get the butterfly concept down if you want to trade volatility, or at least begin to understand trading volatility. All right. Option premium distributions, or death by natural gas. Okay. So that's a hat tip to Bryn, but I want to explain volatility in low to high terms, and then we're going to get into butterflies. Low vol. An example of a low vol market habitually is natural gas summer strip. Okay, if you're looking at your little pachinko machine there, your distribution in a low volatility market is tall with flat tails. And there's your example. The problem with this page is, and I had to draw it in. If you can't read my handwriting, look at this in an X and Y axis sort of way. On the X goes what, left to right? I forget it. It's been a while. Anyway, premium is on the left, is the left label, and strike price is on the right. So the at the money in this normal distribution is the middle, or the peak. It's the peak premium. It's actually usually the lowest volatility in percentage terms, as Tom was showing you on Smiles, but it is the peak in premium. So in your low volatility environment, you see the external factors dropping balls in, and that would be your, say, summer strip in natural gas, and summertime blues, I would call that. In the wintertime, or in a high volatility environment, you see things like this, where the distribution flattens, okay, and spreads out at a higher volatility. So what's end up happening is, if you think about it this way, if your at the money option was worth, call or put, I don't care, is worth 100, in a low volatility environment, your 20 delta option is worth 10, to make it extreme. In a high volatility environment, your at the money option is worth 500, but your 10 delta option is worth 200. So although they both go up, the difference between them, the whole what's what I'm looking for, the whole distribution flattens out as vol goes up. And that's a concept that we used to call Weezu. We will get into that some other time. Cry if you want. That's for people that were short natural gas options during the wintertime. So again, strike price at the bottom, premium at the top. Now, for those of you that are trying to understand strike price at the bottom, the middle is at the money. To the left is puts, to the right is calls. And by that, you should be focusing on extrinsic value, or out of the money puts to the left, out of the money calls to the right. Okay, so let's trade vol. Butterflies determine all. Okay, now just to read the words, because this is all going to come back to Tom in a second. All right, a butterfly, you can read that on your own time. Basically, what a butterfly is forgetting direction for the moment. We're going to pick. I'm going to make a fictitious market up. All right, we're trading. We'll trade the S&P, but it's trading 100. Okay. All right. If you buy the 50 call, one, sell 2 100 calls, and buy the 150 call, meaning you trade 3 equidistant strikes, where you buy 1, you sell 2, and then you buy 1. You are creating a butterfly. You are buying the 50, 100, 150 butterfly. And you are, and this is important, if you buy a butterfly, you are selling volatility. So here's how the thought process would go for a guy who doesn't know Greeks, but who has an opinion on direction. And this is what happens before sheets were invented. A person is looking at a market that's trading 100, and he says, I don't think it's going to go anywhere. But he's got limited capital. He wants to trade volatility. He wants to bet on non-movement. So he starts, think about Larry. He starts by saying, what's the, well, now we can't do Larry yet. Okay. So he says, I think the market will be between 50, will be close to 100 in 30 days. It will be above 50 or below 150, but it will definitely be above 50, below 150, and it'll be probably close to 100. So he buys the 50 call, he sells 2 100 calls, and he buys the 150 calls. Now, we're not going to get into why he did one versus the other in terms of directional stop outs, but the market is in the middle of that butterfly, and it's a call fly. Now, as a side note, he could do the same thing with puts. It doesn't matter. But for this example, we're doing calls. It's the same exact graph. He's betting that the market's not going to move. And if you look at the distribution, the most premium is in the at the money. That's the fattest part of the distribution. So he's betting that distribution at expiration, that at the money option will be worth 0. So the 50 call with the market settling at a 100 will be worth 50. The 100 call, esoteric risks aside, will be worth 0. And the 150 call, that he was short those. The 150 call, which he bought for reasons we're not going to go into right now, but to make sure that he doesn't lose his house, is also worth 0, but he will net make money. He was short volatility by buying the butterfly. Now, I want you to look for a second at the P&L graph. Before there were models, there were butterflies. And then we're going to go right to the whole Larry thing. Okay? All right. That is a P&L graph. The first P&L graph is long a butterfly. Now, butterflies are frequently used for directional plays, but they're really volatility plays. We won't get into why one is the other, but I want you to understand something. When you look at a market, you could do exactly what Larry does, all right? If the market is trading, and according to this, the market is trading 100, okay? The market in this product is trading 100. And you say, you're Larry, right? Or you're a person who thinks volatility is not going to move. You say, I want to sell that 100 straddle. Oh, crap, I can't do that yet. Okay, I don't think the market's going to move. So I'm going to sell 2 100 calls. All right. And I don't think it's going to go above 100 by expiration. But just in case, I'm going to buy the 105 calls to stop myself out. And I will buy the 95 calls. You create what's called the witch's hat. And as a working at a firm that always made us long vol, it was called the witch's hat because it was evil. Never be short vol. But this is a position where you have limited risk, limited reward, and you are betting on non-movement. The inversion of that, which is a V for Vince, for vol, and very happy, is you say, I think the market's going to be way away from 100 by the time these days go by, and you capture all of the money above the horizontal line, loss and profit. Now, I want to go from there and skip through advanced skew lies and fat tails, although it's fun to talk about, and I think Tom and I could have a lot of conversation about this. The world is a lot of normal Myron. We'll skip that. This is skew. It's not kurtosis. Skewness resides in the 20 to 30 delta. That semi-pornographic picture there with the at the money and put skew versus call skew. We're gonna skip the next page, which is skew, the law of conservation of vol and kurtosis. I do want to say this about the law of conservation of vol. I don't know that it's a vol per se, but you have to understand that options graphs and options theory is actually based on rocket science. And bell curves and distributions have a limit to the amount of area they can have under them. So if volatility goes up and the area of the curve remains the same, then your tails or wings drop. And that's what we're looking at here, and vice versa. Okay, going out, iron butterfly trickery. This is what I want to get to and really cover, and then let Tom run with it from there. And I want to read this verbatim. When traders like Larry Benedict talk about the daily straddle, they're almost always looking implicitly at the iron fly. This is how to honestly access their gut for the day's risk tolerances. This is important, selling a straddle and buying a triangle as stop out is selling an iron fly. Now, let's go through the points that I have here. Sorry, Tom, I just want to blow through this so we can discuss
it. All right, no problem.
Okay. First, you have to understand this. Call butterflies and put butterflies, which we have been using as examples, using the same strike, have the same P&L. So the 95, 100, 105 call butterfly and the 95, 100, 105 put butterfly have the same P&L graph. Whether you're bullish or bearish, they have the same P&L graph. If you're doing an at the money, where your mid strike is the at the money strike in the butterfly. The iron butterfly, wait for it, has the same P&L graph as the butterfly, but buying an iron fly is buying vol. Selling a regular fly is buying vol. So buying an iron fly is the same exact P&L graph as selling a call or put fly using the same strikes. Debit, credit stuff, folks. And that's where Tom's accounting comes in. If you ever get confused and you're starting to look at things like butterflies versus iron flies, it's very simple. If money flows into your account, if there's a debit to your account, you're selling vol. If there's a credit to your account, you're buying vol. If there's a credit to your account, you're selling vol. Buying, and we'll get into what this means in a second. Buying a call or put fly is selling vol. Buying an iron fly buys vol. You can review this in a little bit. We're blowing through this to get through inside a trader's brain, or how a mind of a trader works. Combining an iron fly with an offsetting call or put fly creates a box. We'll mess with you some more on that later. Now, before we get to the joke that I have there with Tom and myself, it's kind of like this. A trader, and I'm not speaking for Larry, but a trader like Larry comes in, and he's a classic gut trader from my point of view. And that means his approaches are very flexible and he's dynamic in his trading. One of the key things he'll look at every day for as long as I've known him is he'll look at the straddle. So if the S&P straddle or the ES straddle is worth $40, all right, he may not say it out loud, but what he'll say, let's just say he said out loud, that seems expensive. So immediately in his mind, or someone like him, say, I want to sell that. But then he looks at the markets around him and says, well, whether you're a technician or a momentum-based trader or regression to the mean trader, say, okay, the S&P is trading 2,600. The 2,600 straddle is 40, and I want to sell that. I don't think we're going to move 40 points today. It's expiring today. But if we do move more than 40 points, I can't afford to lose more than X amount of money because that's how I run my fund. So I'm going to sell the straddle, and I want to sell a lot of these straddles because I'm really confident, or I have a high conviction on this trade. But I'm going to take less P&L. I can either sell one straddle and not worry about it, or I can sell 100 straddles and say I can make a lot more money, but I need a stop out to be responsible for my my clients. So the person who sells a straddle then buys an out of the money put. So we're trading 2,600, and he says, I'm worried if we go below 2,550. So he buys a 2,550 put. And then he says, I'm also worried if we get above 2,650. So he has sold. So what he does then, what he could do is he'd sell the 2,600 straddle, he'd buy the 2,550 put, and he'd buy the 2,650 call. Now, that's called an iron fly. And selling an iron fly, which is selling the straddle or the meat, is exactly like buying a call or put fly. That's a little insight into how traders think when they look at daily straddles. And I'm going to turn it over to Tom, just dump it in his lap and just let him go off on stuff like that, relative values, lifting a leg on a fly because you're not bearish or you're not bullish. But I wanted to get that in for everyone so that they can get more out of the AM roadmap with people. So Tom, I'm sorry, I'm just dumping it back in your lap there. I was just
that's quite fun. I thrive on
abuse, like me. Yes,
and abuse, the whole thing. Yeah. Okay. No, that was really well put. Now that's a pretty standard way as to ascertain volatility. And I think Vince touched upon it, but I'll go into it in more depth. Is that if you're out there, I mean, you want to put it in the chat. Let me see if I get the chat up. Let me ask you a question. Netflix and the Spiders are trading at roughly the same price, right? Netflix, with my cursor here, as you can see, trading 265-ish. Spiders trading 263-ish. All right, you got a pop quiz. 270, the 5-point fly around 275 in each of them in January. I want to buy the Jan 270s, sell 2 of the 275s, buy 1 of the 280s in each of them.
Okay,
which one should you pay more
just
for?
to narrow it down, we're talking about an at the money call fly, right? So
yes,
the first call's in the money, the last call's out of the money, and the middle 2 calls are at the money, right?
we're going slightly. Yeah, I'm trying to use like somewhat close to. I'm trying to use 50 delta options as your low strike.
It's fine. It's fine. I just want people to look at it because I just talked about iron flies. I want to stay with call flies. I think you're right about that.
Okay, so let's look. Well, now before I put the answer up, before I reveal the answer, I want to buy a 5-point fly around 275 in each of these. Okay, they're both trading at roughly the same price, 265-ish. Where do you think I will pay? What will incur the biggest debit? The fly in Netflix or the fly in Spiders?
That's a good bet. That's really actually interesting. I hate
so you got to add. No, you got to go back to what Vince said about 5 minutes ago, and what you continue to harp upon. See if you're paying attention. If you're buying a fly, what are you doing with volatility? Right. I don't have the page up, so I don't know if people are answering. So
okay, if you're buying, if you're buying a fly, now if you're buying a fly, you're buying. Are we talking about a fly where the middle strikes are at the money? Just so
roughly. I'm going to buy the 270, sell 2.
No, that's fine, give or take. So if you're buying a fly where the middle strikes are at the money, you're buying the wings, the lower and higher strike, and you're selling the middle strikes. And the middle strikes are at the money, and they have the most premium. So you would be buying a fly, you would be selling more premium. You would probably have a debit, a credit into your account.
Correct. So where are you're selling volatility. So
right.
Where should you incur? Where should where would be the cheapest debit? You got to ask yourself, what's the higher volatility instrument? Spiders or Netflix?
Yeah, that's the thing that I can't answer. I'm not looking.
Okay, well, Netflix by rather dramatically. Netflix, roughly 50. Spiders roughly 22.
I don't have trading sheets in front of me. I'm sorry.
That's okay. So Netflix is trading at a higher volatility. So for you to make the bet, and that's what you're doing, if you're going to buy the 5-point fly around 275 in Netflix, okay, you're saying I think Netflix is going to hang in between 270 and 280 out another month. Spiders, do they hang out between 270 and 280? What is the more likely scenario?
Right.
What has the higher probability of occurring? Netflix trading in between a 270 and 280 range out 6 weeks. Now it's climate, not weather. Someone's got to tell Trump about this. It's climate, not weather, because I'm looking out a month. I'm not looking day to day. But in a month,
could you explain that to me? That's terminology I'm not familiar with. No, I'm serious. I'm not messing around because we used to.
No, I'm saying out 6 weeks. I'm looking much longer term, big picture. I got, like Buffett always said, I got a pretty good idea. Will the market be higher in a year? Yeah, probably. Will it be higher tomorrow? I have no idea.
So that's climate as opposed to day to day.
That's climate as opposed to day to day.
Okay. Gotcha.
So anyway, what is a more? I don't know what you think. You're looking at charts, whatever the hell you've divined. But what is the more likely scenario? Is it more likely that Netflix trades between 270 and 280 out 6 weeks, or the Spiders trade between 270 and 280 next week? Well, volatility tells you that Netflix is a much higher volatility stock, so it's more likely that that spider fly has a higher probability of being in the money than the Netflix fly, because you're selling volatility in Netflix. There's a higher probability that Netflix out 6 weeks, or out 2 weeks from now, is going to be way outside the 270, 280 wings that you bought. So that's in Netflix, you're selling volatility. In Spiders, you're selling volatility. But in Netflix, you're selling 50 volatility. Spiders, you're selling, 22-ish volatility, 23 volatility. So the debit incurred, the Netflix thing should be less of a debit than the Spider thing, because you are selling volatility. And indeed, I'll quickly price this up for you mid-market. You may even get a credit on this thing. Sell 2. What does this thing look like? 15, 10, 50, 170, about 80. What is that? 180. It's about 30 cents. Yeah. The Netflix fly would cost you about 30 cents mid-market. Okay. Now the payoff is attractive, right? You're betting 30 cents. You could make $9.70. Right, Vin? Because 2 cents.
Right. In fact, that's actually a good way to go with this. I'm going to ask you a question that's going to go right to, I think, what you're getting at. The 270, 75, 80 fly in Netflix is worth 30 cents. The max it can be worth is $5, right? Oh, you're using a $10 wide fly now?
We're using a $5 Wi-Fi. $5 okay. 270.
So the 270, 75, 80
correct.
call
That's
fly in Netflix is worth what?
30 cents mid-market.
So if it's worth 30 cents, the max I can make is the difference between the first 2 strikes, which is $5. So I would make $5 after spending 30 cents with, a return of, whatever.
470, right? So you're getting almost 16 to 1.
Yeah, 16 to 1.
About 15 to 1.
That's right. Okay. So if you want to look at it in odds terms, butterflies can be easily looked at in odds terms. So or payoff terms. So 16 to 1 payoff, if you're right. And the flip side is you may as well do the S&P now so we can see.
Yeah, sure. Go keep. I'll hit it. And what I'll do is I'll actually put the screen on there so you can see it. That would be.
There's no free lunch is going to be the moral of the story.
That's the advanced class for someone like myself here. Okay, here's spiders, and I'll share it with you guys. Let me know. You should be seeing the DC spiders populate now. They should have.
Yes. Okay. So right. I want to just throw this in there because people are on with us live. Trump is throwing something that angling for a shutdown or because of the wall or whatever. But we can get into that later on. But the bottom line here is shutdown absolves him from wall reneging on his wall promise. But at the same time, there's going to be an argument about that. Anyway, so back to the S&P fly.
Okay. You see down here, I've just priced up this fly. Okay. I'm buying one of the 270. Same thing I'm doing Netflix. Buy one of the 270, sell 2 of the 275s. Buy one of the 280s. And my debit would be we'll call right in the middle there's 60 cents. So I got to pay twice as much to buy the fly in the spiders as I do in Netflix. And that's a reflection of volatility. So you're selling volatility in both, but you're more apt to win. You're paying 60 cents. And once again, as Vince said, the most you can make is the difference between these 2 strikes. The greatest credit you can generate is $5. You paid 60 cents. $5 minus 60 cents is $4.40. Your payoff goes down to about 7 1/3 to 1. Okay, you see how I got that? $4.40.
So it's like boxing, right, Tom?
It's like what?
It's like boxing. Just say yes.
Yes.
Okay. It's like boxing. When Muhammad Ali in his prime fights me, or why don't we go with Mike Tyson, who was a better puncher? When Mike Tyson goes up against me when I'm in my prime, and he was in his prime, it's a 500 to 1, if not higher, you get for your money when you bet on me. And guess what? That's a great risk reward. That probably ain't going to effing pay off. So if you bet on Mike Tyson, you have to bet 500 to make 1, and you're probably going to pay off. The point is the market handicaps these things properly. So while the payoff is tremendous in Netflix, as Tom pointed out, it's very unlikely. The payoff is tremendous for a reason. Butterflies are statistical bookmakers. And that's the point of understanding volatility in a statistical point of view and an odds point of view.
Excellent point, Vince. That's an excellent freaking point. Hammer that home. That's really good. I think, that's really good. That's exactly, yes, perfect. That's that right there. You're getting a payoff calculator, what Vince is telling you, and that's your bookmaker. And that's essentially what are the, all you want to do is what are the probability of this coming in the money or that coming in the money? Netflix, higher vol than spider. So obviously, higher probability the spider fly comes, it pays off than the Netflix does. The market's saying it's twice as likely, right? You got to pay cents for the Spider one. You pay 30 cents for the Netflix one. The market's saying that if we'll go back to the whole freaking, normal distribution. If I did this 100 times, maybe the Spider thing may pay off 20 times. The Netflix thing may pay off 10 times. That's what the market's saying. Okay, long run thing doesn't mean it's going to work today. And the January one's going to work. That's all. Just in the long run, that's what should happen. That's what statistics tell us should happen, and that's all volatility is. It's a statistical measurement of where stocks can and will go. So obviously, you got to be cognizant of the fact that things have dramatically changed in the last 6 weeks, right? VIX was, I think, in the 12 something. You had these and VIX futures were steeply contango meaning higher from back down to front, higher from front to back as we go back. Now that's flipped into backwardation, which is the exact opposite. So volatility and the fly. I'll stay with the fly again. That hammers it home. You figure out what the payoff is on those flies, what you are betting, what you can make versus other flies. What's the better bet? That's it. All you want to do is make the better bet. Period. You make the right bet enough times, you're going to win. End of freaking story. But Vince is just hammer home the fly thing again, because you are putting it in terms that I think everyone understands. I get a little off topic. Go ahead, man.
No, as do I. But the only reason I explain this way is because it's easier for me to remember. No, but yeah. Well, I get stopped by people asking me questions. That's why I can go back to it. Anyway, so why don't we talk about what time is it?
It's 2 o'clock.
2 o'clock. I think we're done because usually at 1:50 we have to stop. It might let us go, but that's probably because nobody's listening. You're all stupid if you're not listening. Okay? Because why don't we look at the butterfly picture that I put up so you can understand that if you have any problem. The joke there is I'm always a buyer of vol. Tom, can you throw that picture up at the bottom of the story, or did you close the window?
What am I doing here?
In the story that we used, the post that we used for information. The picture of the guy with the glasses.
Oh, right here. Oh, wait. I'm sorry. You know what? I thought that was on the page. I was on a different page. You're absolutely right.
That's all right.
Here you go.
Asking. Come on, I spent a lot.
That good?
There you go. Okay. Now that's a joke, and the joke there is it's on several levels, and it's actually good for you to look at if you're ever confused. I'm always is not the right word, but I'm usually bullish on volatility. And there's a butterfly, and I want to buy volatility, and the butterfly is saying, "Buy me, please." And what I understand actually is that buying a butterfly, because Tom just taught me that if buying a butterfly is selling volatility, so I won't buy that butterfly because it's poisoned. Anyway, bad joke, but a good concept. If you want to understand volatility, instead of working on call spreads and 1x2s and 3-ways and straddle spreads and ratio butterflies and butterfucos and all these condors and Christmas trees, look at a butterfly and start taking pieces away from a butterfly, and you can understand where your directional and volatility risk are. The butterfly is how people used to price things before there were models.
Right, Vince is 100% right, Vince. And like to Vince's point, if you the spreads that we show that we illustrated, like now, look at with the Spiders and with Netflix. I mean, if you took away one of the wings, if you took away the upside call wing, the 280 call. Let me see if I can get this up here for a second. It should be right there. Okay. If I took away that 280 call on the Spiders, well, my payoff is going to dramatically change, right? Now what happens? Now this is a little advanced here, but you want to see where the fly is. But now what I've done is I'm long one of the 270s. I'm sure two of the 275. Well, this would be an insane kind of freaking deal. Well, maybe not, but I mean, I would obviously I'd taken a credit because now I am a seller.
By the way, you're
listening
to Tom talk. You're listening to every trader think. Tom's actually sharing with you his thought process out loud, as does Larry, as do I. But I'm just I have a shock collar on to stop myself. We always are thinking in conditional probability. So I think this, but that, and you look for exceptions. So what seems like ADD, and maybe ADD anyway, is someone thinking in terms of conditional probabilities, and that's why there are a lot of regressions or digressions, I should say, in the thought process. But there's a lot to learn from what's being said here. Sorry to interrupt, Tom.
That's fine. Now this here, if I were to say, hey, screw it, I think we're going to go to 280. What do I need the 280 calls for? That's as high as I think we can go. This 2800 level, SPX, and roughly Spider, the Spider price might be right around the same thing. That's as high as we can go. I think we get there, and maybe we'll play around there and settle somewhere in there. Well, my payoff, if I do this 1x2, 1x2 is going to give me, at 280, the 270 calls are worth $10. The 275s are worth $5 each, so $10. That thing will be zero. Okay. At 280, but what do I get? Oh, I get a credit for this. I can sell this for 20 cents. I can put this on for 20 cents. Okay, so it's important now to look at where are my break evens here. Okay, I buy one of these, sell two of those. I have protection up to where? You're gonna figure that one out. $5 width, you're short two of these. You're protected up to 280. Anything after 280, you're on your own. That's at expiration. Hey, we trade 277 tomorrow. You got problems. So at expiration, my break.
Wait, Tom. You have a 1x2 on. That's what you're describing, right?
Yes.
Okay. So if someone wants to buy an option to lock in their risk or to limit their risk, they would make it a butterfly, right?
Yes, that's correct.
There
right.
You go. And that's what we're talking about here. Know the butterfly, and then you can back out options and learn all these other back spreads that are so important to managing risk.
He's absolutely right. That's 100% right. Because I mean, a lot of you see me. I put a lot of 1x2s in the chat in the last month or so, especially in Apple in light of the recent decline. Now, I paid nominal debits. I'm going to lose 15, 20 cents on a bunch of them.
You do a lot of time spreads too, and I want to talk about that next week.
I got do a lot of time spreads. But here, if I get, I don't want to really talk this.
No, we're gonna have a whole class on time spreads next week, and I think that's going into earnings events, trading around events. That's advanced stuff.
But I think for right now, guys, I think this. If we focus on flies, and if you got a spare 5 minutes here in the next 2 hours, while the market, maybe slows down for a little while, maybe take a look at some flies and some stocks you like. Maybe go out 30. Forget about the binary stuff on stuff that expires Friday. Well, maybe you're really good at it. I'm not. That's not my game. Look at 30 days, 45 days, 2 months. I mean, hey, maybe you're very, very bullish. Maybe you're very, very bearish. Maybe pick out a fly and say, hey, what does that look attractive? Am I getting paid to do this? What are the odds of this happening? You go up and down. It doesn't have to be at the money. You can go look all the way down. I gave out some trees, a little more, a little more advanced stuff, or whatever. You will get.
No. That's cool. It's cool. See, a Christmas tree, which people talk about a lot, is a ratio backstrom where you're long one option, short two. And that, if you add a call at the end of it, we're using calls here, plus, minus, plus in 4 strikes is a condor, which is a cousin of the butterfly. There you go.
Right. I think for right now, guys, let's focus on the fly. I think Vince laid it out for you very, very well. And I think that would be a real good entree, if you will, into determining volatility, not only on an absolute basis in terms of an individual stock, but maybe on a relative basis. Like, hey, where do the spiders line up with IWM? What's that relationship like? What's that fly? Why don't you pick out a fly around a 50 delta call, do the same thing in spiders and IWM and Qs, and determine which asset class. Maybe you could buy a fly in one, sell a fly in the other. There you go. You got fixed risk both ways. Would you be more comfortable buying volatility in one and selling volatility in the other? There's a lot of ways to play the game here. Without, maybe you're expressing an opinion one way or the other, but, look at the spiders, look at the Qs, look at the Marys. I mean, IWM, Russell.
Wait, what's a Mary?
Mary's
Really?
WM.
Terms I don't know here.
I was a floor guy when that thing first came down. The Marys, Nancy's, and Oscars. IWM, and no. Mary, how are the Marys? So I mean, know where volatility resides, and what it's going to do is give you, if nothing else, it's going to foster an understanding or a fluency, if you will, in where volatility on a relative basis on, resides in terms of like, wait, where does Spider Vol against Russell Vol? Wow, it looked like Spider Vol was 5 clicks under Russell. Was 5 clicks under Russell Vol a couple days ago. Now it's only 2 clicks. Maybe I want to sell Spiders and buy Russell. Look for that volatility. The volatility mean revert. Like you go back to ancient history, August 24th, 2015, 100 handle down opening. I remember that it was a Monday morning. Remember that one well. Okay, first time you can go look this up on your screens. I did a spread there. That was the first time. Like, I've been trading this a long time. The first time, only time I had seen S&P Vol for whatever reason. I got my theories. S&P Vol trade higher than Russell volatility, than Mary volatility. Never happened before. Never happened since. So, obviously Mary's are small caps, right? So by their very nature, by the name, you can infer small caps, more volatility. But that time, for whatever reason, I don't know, you were able to.
Sexist. It sounds very sexist.
It's very, very sexist. But that presented a great trading opportunity. I could be completely directionally agnostic. I'll buy. Look, and the market was down 100 handles, whatever that was. Look, I'll split the difference. I'll look up 50 handles, 100 handles. I'll buy flies in one and sell flies in the other, thinking that if vol mean reverts, which it will, it always does. I'm going to capture that Mary Spider relationship has been going on since time immemorial. The Russell Spider volatility relationship is going on since time immemorial. I want to bet that it gets back there again.
Why don't we save the rest of that for tomorrow? The rest of the advanced part for tomorrow, and then we'll do time spreads next week. I do want people to have questions for Larry tomorrow about options. When he says I'm short the straddle or I want to sell the straddle, you should be more informed now about what we're talking about. He's looking at risk. He's taking a gut check on how he feels about the market, and the butterfly is always implied by the straddle. And unless Tom has more to add, I think we've taken up a lot of time, and I'm sure Mike has other things he wants to put on, and people want to get back to trading. I see Larry's been a little bit active right now. Is there anything that you wanted to add at this point?
No, that's great. I just think anyone, if you have, like I said, you spare a minute, look at some flies. Look at some flies and some high cap stocks or high cap indices. I don't know what the proper word is. Look at that and look where they compare. And perhaps you have a benchmark to see where volatility reside in each of these instruments going forward. And then I think once you have that down, once you have that understanding down, or intuitively price the fly, that's what Larry does. He knows for the straddle. What was the straddle today? How many days to go? Boom, 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 boom. What's the linear decay? It's geometric. And that's where he's going with it. So I think once you have that, you're going to have some type of foundation for understanding volatility throughout the freaking curve. So let's try and get this down. Let's try and grasp this concept down. Vince and I will harp upon it again tomorrow, and then we'll go into different topics. But yeah, that's all I got to say, Vince.
Tom, name that tune. You ready? It's appropriate to what we talked about. You ready?
Go ahead. I remember the movie Manhunter, one of my favorites, top 5.
I know.
Mr. Dollar Hyde.
but it's by the band.
Yeah, Iron Butterfly.
There you go.
17-year-old lead guitarist. Boom.
Everywhere.
Is that you playing the guitar?
How old was the guitarist?
17 years old.
No crap.
That's the truth.
All right. Well, you are old. Thanks for listening. And I guess this will be available on replay later on. And tomorrow we'll go through the more advanced concepts of model risk and skew and leptokurtosis, since I think this was more needed. And we might not have had a capacity crowd of more than 5 today on the site because of what's going on with Trump. But those who are listening, thank you very much and have a good day. All right.
Great, guys. Thank you so much. Have a great day.